Okay, a couple of other things that I wanted to share with you here in the first half, and of course it is anything goes summer too. So feel free to call in on anything. Just a quick announcement, by the way. Write down our new phone number. The old phone numbers will still work for at least a week and a half or so, at least until July 1st, and maybe we'll push it beyond that. But the new phone number, it sounds better. You're not going to have your phone dropped on you. You're not going to get weird messages on, if the lines are busy. It's amazing. Competition in the phone, even though there's only a couple of phone companies in this town. Our new call-in number is 202-808-9925. 202-808-9925. And our official announcer voice person will say that, at least once an hour. So you'll have other opportunities to write it down. Danielle will put it on the screen. It's 202-808-9925. So one of the things that I saw while I was actually going through the airport in Paris yesterday, as I recall, day before yesterday, we flew home on Saturday, was this was in the Economist, as I recall. It's funny, some magazines don't show the name of the magazine. I tore the article out, but it doesn't give the name of the magazine. That's downright baffling. Anyway, the title is "The Next Debt Crisis," and the article points out that enticed by they start out by saying, the last big crash was caused by individuals going into debt for real estate. So we had this huge debt bubble for real estate. That debt bubble crashed, and then all the derivatives. So there was a multi-billion-dollar debt bubble. But then on top of that, there were trillions of dollars, hundreds of trillions of dollars of derivatives that were based on that debt. Well, now we've got a new one. And the new debt bubble is corporate debt. And what's so mind-boggling, and I've explained this a few times on this program, it's the sort of thing, though, that you really have to. It seems complicated. It's really quite simple, but you really have to understand how this thing works. How it is that big corporations and multimillionaire and billionaire CEOs get that way. And how, in a time of declining wages, declining productivity, or at least relatively flat productivity, last quarter we actually saw a decline in productivity, and declining profits, how is it that the corporations' stocks are going up? Well, it turns out, enticed by super low interest rates, keep in mind, corporations can borrow right now at 2-3%, very, very low interest rates. They borrow by issuing corporate bonds, and people buy the corporate bonds because, hey, it's a better interest rate return than if I buy federal bonds, which are like, 1.5. Now, there's a little more risk with the corporate bonds. And some of them, even pay 3, 4, 5, 6, 7% because they're really risky. But anyhow, the total, enticed by super low interest rates, American corporations increased total debt by $2.8 trillion over the past 5 years to a record $6.6 trillion. In 2015, just last year, liabilities, this is the amount of money that corporations owe, outside of their debt, jumped $850 billion, 50 times the increase in cash holdings by S&P Global Global Ratings Reckoning. John Lonsky, the head of Moody's Capital Markets, he says companies have been adding to their debt, and their debt has been growing more rapidly than their profits. This imbalance has led to, in the past, has usually led to problems. Yeah, you think? Here's what's going on. If, say, there's 1 million shares of stock out there, and the stock is selling for $100 a share, if your company then borrows enough stock to buy 100,000 shares of stock, enough money to buy 100,000 shares of stock back out of the stock market, the number of stock shares out in the market goes from 1 million down to 900,000, which means that but the company's still worth the same. So the value of each share goes up by 10%, even though the company took on debt to buy those shares back. Now, when the value of the shares goes up, what that means is that the the senior executives who compensate themselves with stock, with shares. They sell their shares that they bought at the lower price before they borrowed the money to buy the shares out of the marketplace. They sell those shares and they show a profit and they pay a maximum 20% income tax because it's capital gains. In other words, they're gaming the system. What we're seeing is a massive, they said in April marked the third straight month of falling orders for business equipment. It's the lowest in 5 years, $62 billion. Corporations are using the money for short-term purposes. A wide gap exists between a handful of ultra-rich companies and the rest of corporate America. For the most part, corporate companies aren't pouring the money they borrow into capital expenditures to increase efficiency and capacity. See, it used to be companies borrowed money to grow. Now they're buying money so that their investors and their CEOs can get richer, investments that could boost profits down the road. Instead, much of it has gone to finance share buybacks, dividend hikes, and acquisitions. Just since 2009, just to the S&P 500 companies have borrowed more than $2 trillion just to repurchase shares, which basically means $2 trillion coming in debt to the corporation and in cash to the executives. Everybody else, screwed.
You're listening to the Thom Hartmann Program. Call 202-808-9925.
It's amazing. They point out that last year, McDonald's sold $6 billion worth of bonds just to help finance higher dividends and share buybacks.
To watch more clips from our programs, hit the Watch More Videos button over here. And please be sure to hit the handy-dandy subscribe button so you'll always be up to date. Tag, you're it.